Hello, we're back to continue our discussion about evaluating your mortgage options. Over the next few minutes, I'll discuss whether or not it makes the most sense to choose the mortgage with the lowest interest rate. When shopping for a mortgage, you might notice that interest rates can vary between lenders by 0.5% or more. There are many reasons for this, not the least of which is a lender's interest rate quoting strategy. Because lenders know that the majority of borrowers simply look for the lowest interest rate they can find, they publish rates that may appear much lower than a competitor because it's more likely to make their phone ring. What many people fail to do is read or understand the fine print, and many lenders intentionally make the fine print hard to find. The fine print often includes additional fees and requirements and may also exclude key costs such as private mortgage insurance. So, while almost everyone shopping for a mortgage is looking for the lowest interest rate they can find, this could be a very costly mistake. It's important to understand that the lowest interest rate available for a specific loan type or product will always come with the highest fees. This is a fact universally true, despite the lender. In other words, you will never find a mortgage with the absolute lowest interest rate and with the absolute lowest closing costs. This is because to lower the interest rate, you end up paying fees known as points or discount points for the life of the loan. And the time required to recapture the upfront cost of the points is measured in months, years, or even a decade or more. Another common misconception is that the lowest interest rate also ensures the lowest monthly payment. Your monthly mortgage payment may not be made up of just principal and interest. If you have less than 20% equity in your home, you will also pay private mortgage insurance, or PMI for short. Some, but not all lenders, may provide a borrower with multiple options to pay PMI. The most common is the monthly PMI payment, added to the principal, interest, taxes, and insurance, which make up a total monthly house payment. Prime Lending offers several additional PMI payment alternatives, which your home loan expert can walk you through. What's important to note is that your choice of PMI may impact your monthly payment more than interest rate, meaning that in some cases you can obtain a lower monthly payment with a higher interest rate. So when does choosing the lowest interest rate make sense? It depends on how long you are likely to keep your loan. And remember, even though you may plan to live in the home for the next 30 years, that doesn't mean you will keep your mortgage that long. The average life of a mortgage in the United States is between 8 and 9 years. Why? Because life happens. For instance, interest rates may fall, making refinancing an option. You improve your credit score. Your family is growing. Your home needs renovations, updates, or repairs. Your income increases or decreases. Unexpected expenses cause you to withdraw equity, or you're relocating for your career. If you make your mortgage decision based on the lowest interest rate, it could prove to be more costly compared to options where the rate may be slightly higher, but the mortgage offers a different term, program, fee, or even PMI structure. We encourage you to allow your Prime Lending loan officer to take a different approach by taking into consideration how long you're likely to keep your loan. This will open your range of options to include different products, interest rates, and loan structures that will ultimately provide you with the lowest total cost of ownership over the expected life of your loan. In some cases, the lowest interest rate may be the right financial decision, but in other cases, it isn't. Contact your Prime Lending home loan expert to get started evaluating your options.